All right, let's dive right in. Today, we're going to tackle one of the biggest, most fundamental questions in all of investing. What is a stock actually worth? We see the prices flying all over the place every single day, but what's the real solid value hiding behind all those flashing numbers? Let's figure it out together. Okay, so before we even touch stocks, let's talk about something way simpler. A donut. How much would you pay for this donut right here? A buck? $2? Now, what if I told you it was the last donut on Earth? All of a sudden, you'd probably be willing to pay a whole lot more, right? But what if you just ate the entire dozen? Honestly, you might not even take this one for free. And here's the key right there. The situation, your mood, how hungry you are, all of that changes the price you're willing to pay. But the donut? It's still the exact same donut. Nothing about its fundamental deliciousness has changed at all. And believe it or not, that is pretty much how the stock market works in a nutshell. It's a giant arena where people's feelings, their excitement, their fear, push prices up and down, often completely disconnected from the actual underlying business itself. So that brings us to our first big question. If a company doesn't really change all that much from one day to the next, why on earth do their stock prices swing around like a roller coaster? I mean, just take a look at a real-world company like General Motors. They build cars, they build trucks. It's a pretty steady business, And yet, within just 1 year, the market decided the company was worth as little as $45 billion and as much as $62 billion. That's a $17 billion swing in value. Did GM's business really change by $17 billion in a few months? No way. So what is going on here? The answer is almost ridiculously simple. It really boils down to just 4 words. The market goes nuts. It's just that simple. It's an emotional creature driven by cycles of fear and greed, and that's what causes these absolutely massive price swings. So to wrap our heads around all this madness, the legendary investor Benjamin Graham came up with this brilliant little story, a way to personify the market's wild behavior. He wants us to meet a character named Mr. Market. So the story goes like this. Imagine you're in business with a guy named Mr. Market. He's your partner. And, he's a decent guy, but he's incredibly emotional. We're talking wild, unpredictable mood swings that dictate everything he does. So on any given day, he's one of 2 people. On his good days, he's euphoric. He thinks your business is the greatest thing ever, and he'll offer to buy your shares from you for way more than they're actually worth. But on his bad days, oh boy, he's in a total panic, he's convinced the sky is falling, and he'll come to you desperately offering to sell you his shares for a massive discount, maybe even 50 cents on the dollar. Now, here's the secret sauce. You don't have to listen to him. His mood swings aren't a threat, they're an opportunity. So your job as an investor is actually pretty simple. First, you do your homework and figure out what a company is really worth. Second, you just wait. You wait for Mr. Market to have one of his classic bad days. And third, you take advantage of his panic and buy a great business for way less than it's worth. That gap between the price and the value, that's what we call your margin of safety. Okay, that sounds fantastic in theory, right? But it begs the most important question of all. If the price Mr. Market is shouting at us every day is just noise, then how in the world do we figure out what a business is actually worth? Really, the entire idea of value investing boils down to one simple question. If I offered to sell you this $10 bill for just $5, would you do it? Of course you would. It's a total no-brainer. Well, that's exactly what we're trying to do in the stock market. We're looking for $10 bills that are on sale for $5. So what is that $10 bill? What's the real value? Well, it's not about today's stock price. The true intrinsic value of any business is simply all the profits it's going to generate from now until the day it closes its doors, all added up and adjusted to today's dollars. It's all about the future cash. So let's just take a super simple look at a company like Apple to see how this works. Say in year 1, they make $40 billion in profit. Cool. But when you buy the stock, you're not just buying that 1 year. If Apple can keep growing its sales, say 5% a year, those profits are going to get bigger and bigger and bigger. The company's value is the sum of all those future profit streams. And this right here is where things get tricky. And it's why people disagree so much on what a stock is worth. Your assumptions about the future change everything. If you assume that steady 5% growth continues, you get a high value. But if you think, nah, their growth is over, and assume zero growth, the value gets cut almost in half.
And if you think a new competitor is going to crush them, the value absolutely plummets. It all comes down to the story you believe about the company's future.
Okay, I know what you're thinking. Calculating all future profits forever sounds impossible. And you're right, it's really, really hard. But thankfully, there's a fantastic little tool that gives us a great starting point for understanding how the market is valuing a company right now. It's called the price-to-earnings ratio, or just PE for short. And honestly, it's the #1 go-to metric for getting a quick feel for a company's valuation. All you do is take the current stock price and divide it by the company's annual profit, or earnings, per share. But a number is just a number, right? What does it actually mean? Well, think of it this way. A PE ratio of, let's say, 15 basically tells you that if the company's profits stay exactly the same, it would take 15 years for you to earn back your initial investment. It's like a payback period. So here's kind of a rough guide you can use. Anything under 10 might be a sign that a stock is cheap, or it could be a red flag that the market expects trouble ahead. Around 15 is pretty much average for the market. Once you see a PE in the 20 to 25 range, that's the market signaling it expects really good, solid growth from that company. And above 25, well, expectations are sky high. A good way to think about it is like you're at the grocery store. A fantastic, high-quality company that's growing really fast is like that premium organic product. It's just gonna have a higher price tag, or in our case, a higher PE ratio. And a lot of the time, you get what you pay for.
All right, we have covered a ton of ground today, from crazy business partners to grocery shopping for stocks. Let's pull it all together and make sure we walk away with the most important lessons.
So let's just recap the big ideas. #1, stock prices are volatile because our business partner, Mr. Market, is an emotional wreck. #2, this is not something to be afraid of. It's your single biggest opportunity as an investor. 3, your entire job is to buy a dollar for 50 cents. 4, remember that a company's real value is always tied to its future profits. And finally, #5, the POE ratio is the perfect tool to start with to get a quick read on what you're paying for.
So there you have it. That's the secret. The game isn't about predicting Mr. Market's crazy moods. It's about knowing what a business is worth and having the patience to wait for him to offer you a screaming deal. So now you know what to do. The only question left is, when he's scared and everyone else is panicking, will you be brave enough to step up and buy?